What if everything you've been taught about saving money is backwards? Has money ever stressed you out? Have you ever felt like no matter how hard you work, you just can't get ahead? Well, you're not alone. This live talk is all about taking confusion out of money and showing you a simple framework the wealthy have used for decades. Even though most people have never heard about this, it's not a theory, it's not a sales pitch, it's just a process and one that finally makes sense. Let's dive into the live session. Some of you are not going to agree with what I'm going to show you, but I'm just going to point out the facts and I'm going to point out the signs that we all need to be looking at, because the cool part about this room and what we do here is, you know, the worse it gets out there, and I don't know, anyone been paying attention to what's going on out there? Kind of starting to really get alarming. I mean, there's just a lot going on, but the noisier and more chaotic it gets out there, the calmer it is in here, because we control our money. And that's the number one thing. We've been taught our whole lives not to control money. We've been taught to give our money to somebody else, give our money to the banks, give our money to Wall Street. And this is where you've got to change that. This is where you've got to control your money. And that's what I'm going to do over this time. Me and Stephen are going to show you how to take back control of your money, how to become your own bank. And now I'm going to show you why this is so important. So on these slides, I just want you to pay attention to them. They're just visuals. This first slide shows what's going on in the economy. Now, you'll notice I stopped it at 2008. I could have went right through to now, but this is showing the debt cycle. There are three major economic cycles we all need to become very aware of. Okay, there's a short-term debt cycle. Everyone in this room has seen those. Everybody's been through those. Then there's a long-term debt cycle. Some people in this room have never seen the impact of a long-term debt cycle. And then there's a technology cycle, which we don't really need to get into. All I can tell you that you need to be aware of is if you just do the math, we are at the end of all of those cycles. And I don't care how, much you believe in the president or the people running the country or the economy or any of the companies that make up the S&P 500, the NASDAQ or the Russell. I don't care how much you believe in them, that none of them can beat the cycles. That's all this is. Don't make it anything more than that. But this one right here does tell a pretty compelling story, the long-term debt cycle. If you go back to 2008, you can kind of see from 1929 to 2008, we all know 1929, right? What happened then? The Great Depression. And what happened in 2008? The Great Recession. How many of you felt the impact of the Great Recession in 2008? Put your hands up high. Now, I want you all to keep your hands up and look around the room. There are a lot of people in this room that have not felt the impact of that. And that's an interesting thing, but it also shows you how far past the normal corrective cycle we are. I think the math is if you're 36 or 38 years old or younger, you've never felt the impact of a recession. That is crazy. And that is going to become reality. But you know what? That's good, because in chaos creates opportunity. This one's pretty interesting too. GDP, this is what they tell you, right? Is near 4%, but hiring is very important, is lagging. And I don't know if any of you saw, but they had this revision that came out not long ago. They missed it by like a rounding error of 911,000 jobs. Whoops. I don't know about all of you, you're probably pretty good at math, but we make some errors sometimes. We miss a zero. They missed a lot. They missed almost 1 million jobs. Okay, that should tell you something. Keeping going. Here's markets. Look at these slides. Every one of these are the markets. The Dow Jones, the S&P, Bitcoin, you got home prices. All of them are maxed out, which is great. That means you're all making a bunch of money, but it also means there's some downside we need to be paying attention to, because can everything just keep going up, up, and up? No. It must come down. And that's what we have to understand. The one thing on here I want you to focus on is gold. Who in here is a gold investor? Anyone besides Stephen? Okay, we got some gold investors. What makes gold go up? What makes gold go up? Anyone who wants to announce it? I was pointing to you because you have gold, but what is one thing that makes gold go up? Yes. Uncertainty. What else? What is it? Scarcity? Scarcity? But I mean, you could just sum it all up as fear, right? When there's fear, precious metals, specifically gold, goes up because it's a store of wealth. That's all it is. Gold doesn't pay you any interest. I mean, there are ways to make interest from it, but it doesn't. You just put money there and you just hope it goes up. There's a lot of hoping, but gold has done really well. All-time highs. That signifies one thing: fear.
And when there's fear, there is uncertainty, and people don't act. People don't make decisions. People just freeze. It's like a deer in headlights. But again, like I said, when we look at Wall Street and we compare it to Main Street, all of you can see this. This is very easy. Living your lives, right? Going out, seeing what's going on. That's Main Street. And then you got Wall Street. Headline news. Almost, it seems like almost every week, right, Stephen? All-time highs. Does it make any sense? Well, it does when you actually look at the charts. Here's Wall Street, okay? 17.62% was the return based on the date here, which is October 2nd. Now, I want to show you another slide. Just look at that. That's a nice little run up, right? If anyone's invested in the S&P, pretty good. Okay, unless you were invested in IULs. Anyone see the Kyle Busch story? I'm not really going to hit that one. I hit that enough. Okay, but I think we all kind of can see that there's a little bit of problem there, and we're going to see more of that. But look at this chart one more time. Look at that run up. Now I want you to compare that to this. And I just want you to look closely at this. 10-year credit card debt. Let me go back. Let me go forward. Back. Forward. Looks pretty much the same, right? You would almost, if I got rid of this big word that said 10-year credit, what would you think this is? You would think this is the S&P 500, right? How about over here? Debt balances. That's non-housing debt and housing debt. Kind of looks similar. All I'm trying to show you is these two things are absolutely correlated. You see, there's an interesting thing. We talk to hundreds of people every single month. People just like all of you, many of you. And what we find out in these discussions is there is a lot of people struggling with debt. We'll never ask people to say, oh, who's buried in debt in here? No. But there are a lot of people that have a lot of debt. And that debt is what has fueled this economy. Not just our debt, not just credit cards. They printed $5.2 trillion during COVID. $5.2 trillion out of thin air. What did that do? It devalued your dollars in your pocket. So the money you hold in your pocket went down in value. As soon as they print money, that's how they do it. They print it, and the value of the money we hold goes down because they have to print it out of thin air. And you know what else that does? That's inflationary. More money in the system, dollars become worth less, prices appear to go up, which they do go up, but really what's happening is your dollars are buying less. That's all that's really happening. So I'm just trying to show you that Main Street and Wall Street are completely disconnected. This was another good one. Jobs are slowing. Unemployment rates are going up. In August, 22,000 jobs were added. Let's say you heard headline news, 22,000 jobs. Me and Stephen talk about this stuff on WTF every week. You would be like, oh, not bad. If you had nothing to compare it to, you'd say, all right, cool. But then if you then saw the rest of the article, which is usually all the way down at the bottom after 50 ads in small print, it then says, oh, they were short of the expected 75,000 jobs. A little different, isn't it? But see, this is what's happening. If you read the news, if you follow the news, you're just not getting the whole story, but it's no different than your whole life. What you've been taught about money is not the truth. It benefits somebody else. And I got news for you. The cavalry isn't coming to save you. The banks aren't going to save you. The Fed's not going to save you. The government's definitely not going to save you. You could tell New York City that a little bit, but some people there actually think the government's going to save them. Okay, well, we'll see how that little experiment goes by. All I'm trying to say is in this room, the cool thing is we are the cavalry. Think about that. We are. In this room alone and with PMC, which is, I think, over almost 10,000 people right now, might be over that, plus our BYO business, which is thousands of people, we have the ability to change every one of your lives, including every one of their lives, by solving each other's problems. So we don't need to deal with all this shit that I'm just showing you. We have the ability to be the cavalry. We have the sole ability in this room to solve people's problems. There are people in this room that need money. I know Ben over here, I met him out in Cabo. He's got deals all the time. He needs money. And there are people in this room that have money and they're like, who do I lend this to? How do I do this the right way? Well, that's it. You two meet. That's all that has to happen. Government shutdown. This is an interesting one. And, this isn't the first time, but it's headline news every single day. And you know what? Anyone here deal with any flight interruptions on the way down here? Good. We got a couple. But we're probably going to deal with some flight interruptions on the way home. I heard that Delta canceled a whole bunch of flights, all because of the shutdown. And can you blame them? They're furloughed. You can't blame them. But what is this really all about? One word. Who can tell me what this shutdown is all about? What is it? Leverage. That's all it is. Leverage. They're using, never let a good, how do they say that, Stephen? Never let a good chaos or never let a good situation go unnoticed.
Go to waste. Yeah, exactly.
Yeah, whatever that is. Crisis go to waste. Thank you. That's what's going on in the government shutdown. But none of this stuff matters. So why am I talking about it? Because when it's crazy out there, it's calm in here. That's all I'm trying to instill. And that's what I'm going to show you. I'm going to show you how to take control of money. I'm going to show you how to become your own bank. And I'm going to show you why. Because it's great. I could say, hey, everybody in here, you should be your own bank. And everybody just says, oh yeah, okay. Don't do that. Ask why. Why should I be my own bank? Why should I want to take control of my money? Because we should never just accept what people tell us as the gospel. Do your due diligence. I say this all the time. I do way too much due diligence and I miss deals all the time. Steven sometimes gets frustrated with me. He's like, come on, it's a good deal. I'm like, I don't know. Maybe it's not. I'm always looking for a way to destroy a deal before I'm looking for a way to commend a deal. I want that deal. I want to know that it's going to fail. And then when I find out it's not, then I feel like I got a good deal. Because I've made, you know how I learned this? It's not because I'm smart. It's because I've screwed up a lot. And I don't want to do it anymore. And that's what I do. And Sean always says this. She says, Stephen and I take these bad situations we've been through in our lives, these failures, these mistakes. We learn from them, but we don't just hold it in. We share it. We go out there and say, hey, guess what? I messed this up and here's how I made the mistake. And now you don't have to make that mistake because it cost me money, not you. But this is where we're going to learn how to protect your wealth. And that's really what it's about right now. But what if I could tell you that you could protect your wealth at the same time as growing your wealth? Because a lot of times people think, well, if I'm going to grow my wealth, I got to take on a lot of risk, right? Who thinks that? To grow your wealth, you think you got to take on risk. Okay, a couple people, but that's good. Some people in this room already know that isn't the case. You can actually grow your wealth and protect your wealth if you know how to do that. Now, who in this room knows how to make money twice on their same dollar? So if you've got $1, I'm just going to hold up a $2 bill, but you got $2. Who in here knows how to make money twice on this dollar? Yeah, a bunch of you. Who in here wants to know how to do that? Because it's pretty simple. And it's something that Albert Einstein talked about a lot, compounding interest. But you can't use compounding interest and make money twice. Because here's what we've been taught about compound interest. We take our money and we put it somewhere in a bank. Felix is going to be my bank. We put it in the bank and Felix is going to pay me interest. How much are you going to pay me, Felix?
2.5%.
I'm going to go to Bank CMG. They're going to pay me more. Sorry, Felix. Where are you, Harrison? Come here. Harrison George, put your hands together for this man. He's now my bank. How much are you going to pay me?
3.5.
3.5. I got 3.5% over here. Now I'm making 3.5%. How many of you would think that would be a fair interest rate to make on my guaranteed safe cash? Is that pretty good? Not bad. 3.5. Harrison, can we go to 4? Because some people in here are saying that's not good. 4% a little better? Who in here thinks 4 is good? 4. All right, we got 4. So Harrison's going to give me 4%. Now, let's say Felix, I'm going to bring you back into the mix. Felix comes to me with a really good deal, and he's going to pay me 12%. 12 is better than 4, is it not? So I'm going to go back to Harrison. I'm going to say, Harrison, I would like that money back. You're only paying me 4. Thank you. And I'm going to come over here, and I'm going to give it to Felix, who's paying me 12. What return am I making on my money here? 12. 12, right? It's pretty simple. But I was making 4, and now I'm making 12. But wouldn't it be cool if I could make 4 plus 12? Wouldn't that be better? If I don't have to work harder, longer, or take on any more risk, that just seems like a better deal, doesn't it? Stephen, when I talk about how to become your own bank, what is the first thing that comes to your mind?
Becoming an actual bank, which...
But I think there's only one person in here that actually owns a bank.
That's what I was going to say.
Right? Is there anyone else in this room? 2 people own a bank. You own a bank? Okay, so we got 2. You're not alone anymore. We got 2 people.
Competition.
In
4.5%? 4.5%?
Yeah, we got 4.5.
All right.
So we got 2 people in this room that own banks, or families own banks. That's pretty impressive, is it not? Anyone ever been in a room where the person who owns the bank is in the room? I haven't. But that's what you think, right? And I'll ask either one of you, but to open a bank, what do you got to do? First, you got to find a bank or find a location. You got to build a building. Then you got to spend lots of money in marketing, right? A lot of money in marketing to attract customers to actually want to come to your bank. You probably got to pay more interest than Felix was willing to pay because everybody's rushing out of Felix's bank to go to CMG, okay? Because he's paying a rate. And how much are you going to pay? More than CMG? See, it becomes competitive. Now, all of a sudden, now they're all fighting for it. And then once they get the money, then all of a sudden people come to their bank and they want to borrow money. And that's how banks make money. It's pretty simple. I'm going to show you that. But that's what you think when you think about being a bank, right?
Yeah. Yeah, it's a lot.
So it's a lot.
I like the way we do it much better.
The way we do it, we're going to simplify it. I'm not going to get into my story, but I love this quote and I always say it. The biggest problem in the United States, the biggest problem in America is not what people don't know. The biggest problem is what we think we know that just ain't so. I'm just going to do a quick story. I don't know what year it was, 2014 probably. I was out in Utah snowboarding. There was a guy there, Mike. Mike lent me a lot of money. He was a private lender. Me and my wife were doing a lot of real estate back then. And he was lending me money. And I called him up and I said, hey, can you meet me at, I got a deal I want to show you. And we met at Cheesecake Factory. When we met there, I just asked him a question. I said, so Mike, how do you lend all this money? I'm thinking he's going to say self-directed IRAs, or he's going to say, I just lend from my bank account. But he says, no, I lend from my private bank. I'm like, oh, private bank, okay. And I'm like, what do you mean? He's like, well, I have a bank and I just lend from that bank. I'm like, holy shit, Mike, you and your family own a bank? I knew they were wealthy, but I'm like, you guys got a bank? He said, no. We just do what a bank does. He goes into this whole thing telling me, how this works. He gets guaranteed interest. He's got dividends on his money. It grows tax-free. I'm listening to this as a financial advisor because I was an advisor back then. And I'm like trying to compartmentalize this whole thing and figure out what is this crazy thing he's talking about? Because I'm thinking, shit, this guy's got more money than me. He's a little smarter than me. I want to talk to my clients about what he's talking about. But I had no idea what he's talking about. And he goes on and he says, and here's how it works, Chris. What I do is I go into my private bank, I borrow money, and then I give that money to you. And then you pay me 12%. So that's pretty easy, right? We're all tracking that. And then he says, then you pay me interest and I take the interest you pay me and I put it back in my bank. You're going to be my bank for now. Okay. I put it back in my bank. I'm like, okay, so you take the money out and then you take it and you put it back in. That's pretty simple. We do that every single day. Everyone in here does that. You take money out of your bank, Bank CMG, his bank, somebody's bank, and you go out there and you use it. And then you take the money you make and you put it back in the bank. So you see, this isn't very complicated. This is what we do every day. But then he tells me this. Then he says, but the original money that I put into my bank never stopped earning interest and dividends in a tax-free account. I said, Mike, I'm sorry. Can you just repeat that? Because I didn't understand that. He said, yep. The original money was called 100 grand that I had in my bank that I then took out and gave to you. That money is still making interest and dividends in an uninterrupted fashion. I'm like, whoa. What does that mean? That means Mike's making money twice on the same dollar. And that's what we all need to do. But you see, I fought it because the next thing Mike said to me is I said to him, what is it? And he says, you know what this is. You're an advisor, right? Which then I felt stupid. I'm like, yeah, I do know what this is. I have no freaking clue what you're talking about. He says, well, you guys have whole life insurance, right? I said, yeah. He said, well, that's what it is. It's a specially designed whole life insurance policy from a mutually owned company that pays dividends. Let's go back to Will Rogers' quote. The biggest problem is not what we don't know. It's what we think we know that just ain't so. So I was an advisor for many years up to this point. And I'm thinking to myself, dude, somebody just lied to you. That's a scam. There's no way it works that way. I know because I'm a financial advisor and I have never, ever, ever seen a whole life insurance policy that does what you just said. So someone's wrong here. And clearly we found out who was wrong, and it was me, because he then said, well, if it doesn't work that way, how have I been doing it all these years? To which I had no answer. So I just played smart and I was like, okay, well, can you show me how to do this? And he said, nope, you got to learn from this guy, Brent. But anyway, it's so freaking simple, but so boring. Whole life insurance. Who would have thought, right? But here's how it works. It's so easy to understand because the banks have figured this out and they've been doing this for a long time. It's called BOLI, bank-owned life insurance. And you know what? When you get into it and you look at the banks, my slide's not coming up, but banks, as of this old slide, had $75 billion in whole life insurance policies. When you start really looking at that, why is it that the banks are putting the money in the exact place they're telling us not to put our money? No disrespect, but for the two gentlemen in here that have banks, do you guys sell whole life insurance? No, not great answer.
Not yet.
Not yet. But that's the thing. Like you go to any bank, Key Bank, or you go to Wells Fargo and you sit down and you say, hey, I want to put my money where the bank puts their money. Are they going to come back and be like, great, here, let me come over here and we put our money in specially designed whole life insurance policies? Did you think that's what they're saying? No, they're saying, hey, let me walk you over here to our financial advisors and they can talk to you about structuring a portfolio of stocks, bonds, mutual funds, and ETFs. That's what happens. Definitely not whole life. All right, so let's keep going. Banking principles. How does the machine operate? Stephen, can you help me walk through this? Because this is a pretty simple one. And I know a lot of you have seen this because you've watched our videos, but it's still sometimes I think it's so important that I repeat myself over and over because the simplicity and the fundamentals of this are what we need to know. So you want to kind of walk through this? So Stephen, I got some money and I'm going to put it into a bank.
Okay. All right. So we take our money and all of us do this every single day of our lives, right? So you get paid, you get a deal back, you get a chunk of change. What do? You go down to the local bank and you deposit it into that bank, right? And then what does the bank do with that money? Are they going to put it in a little box?
So Mike, you're the bank. What are you going to
write your name on it?
You're going to put this in a little box with my name on it? He'll put part of it in. About 10%, right? In that tier one? Yeah. Okay. Yeah.
So 10%. So 10% goes in a little box. Then what's the rest of it?
Where's the rest going to go?
What do you say?
He's going to let people borrow it.
Let people borrow it. Okay. So maybe anybody need to buy a home traditionally? Anybody looking to buy a home right now?
Ben needs money.
First home, second home. Okay. Right here. Okay. So what do? You go down to the bank and you apply for a mortgage, right? Okay. Well, hard money lender. Traditionally speaking,
he's evolved.
So I go down to the bank over here and I say, I'd like to apply for a 30-year mortgage, right? And then where does that money come from that the bank is going to lend to me on a 30-year mortgage? Where does that money come from?
Mike, where are you going to lend from? Is that the money I just put in the bank? But don't you have to ask permission to borrow or to lend my money? You don't.
As soon as you give
I'm not in control of my money anymore.
Money to the bank, you lose control?
That's what Mike's saying.
Okay, so Mike's now in charge of that money.
Mike's in charge.
I'm making my 1%.
And Mike's giving that money to Ben.
Ben, okay. All right.
All right.
And then Ben goes and finds the home he wants. What does he do then with the 30-year mortgage money? He gives it to the seller. Then what does the seller do? The seller takes it and deposits it right back in.
We got some money I can borrow.
Is that how that works?
Money? Hold on.
Okay, we got more money moving around.
More money moving around.
All right, Chris can
be broken into this. Yeah, the seller's just going to take the money you just gave him and they're going to put it back in the bank. That's fine. Okay. That works, isn't it?
All right, so it goes right back to the bank.
Yeah. All right, so now does this go in the vault?
Does that go into the little protected?
You're gonna lend it out again? All right, so he's gonna lend it out of a car.
Oh, who's buying a new car?
Anyone got a new car?
Okay, you go get an auto loan, and so you go down to the dealership. You take the loan from the bank, you give it to the dealership selling you the new car, and then does the dealership then take that money and put it into a case? No, they put it right back into the bank.
Yeah, so now I don't.
Okay, so he gets money back again.
Somebody else is now putting money in your bank. Anyone else got some money? Putting money in Mike's bank?
Fortunately, my wallet's not on me. No.
Okay, yeah, that's funny how that works.
Okay, all right. So then what?
All right, fine. I'll go into the other pocket.
What does he do then? Oh, this guy's got cash. Go. Somebody rob him. Okay,
there we go. We got some cash.
All right. So now we're taking that. What's next, Chris? What's next?
Oh, here.
What's the bank doing now?
See, we're not running out of money because everybody in here has got money. So we're just going to.
So Ben, the home he just bought, needs a new kitchen and bathroom and roof. So then he goes back to the bank to get a home remodel loan. Okay, so the money comes back out.
Okay.
Goes to the contractors. The contractors then take that money and do what? Deposit it right back into their business account at the bank. All right. Seems like the bank's getting a lot of money here. All right.
Like that.
Then what happens?
Thing.
Up to the contractor right back. All right. And then you've been living in that house for a few years. You got your auto loans. You have some kids. Maybe you build up some debt. Some debt?
Sure.
Yeah. All right. So now you need a debt consolidation loan. Let's go back to the bank. We're getting that money. We got to pay off the Visa, pay off the Best Buy. I was told yesterday Best Buy's still around. I didn't even know that. You got to pay off the Macy's credit card. Macy's, are they still around? All right. You got to pay off all the credit cards, right? So then what are those credit card companies? They're banks. So the money goes right back into those banks.
So now you're just going to deposit the money back in his bank.
So that money we originally put into the bank, then got moved all over to all these different places in the economy where we had no control over where it went. And then what did the bank make? So the bank made...
Well, I don't know. They were paying us 4%.
Okay.
We found a really good bank that pays us 4%.
Okay.
Okay.
Yeah, that was.
But then they lent the money out the first time to Ben at 7%.
Okay.
Okay. So they made a spread of 3%.
3%.
But then all of a sudden they went out and said, who was buying the car? You bought the car. Somebody had the. You're the contractor. Where's my car person?
Okay.
Yeah. Somebody bought a car. Okay. That was 8%.
So the bank made 4% off that.
The bank made 4%.
Okay.
Okay. Then we just go around. And anyway, the bank at the end of the day made a spread of 20%.
Okay.
You're doing pretty good. Is that a good return on your money? That's not bad, Mike.
And then you paid us 4%.
How much risk did you take doing all that? That had to be super risky. How much risk did you admit? How much risk did you take? His answer wasn't my money. But even though it wasn't your money, because you're right. Hey, someone's going to bail you out if you screw up, right? Yeah, the Fed, right? Oh, the Fed's just going to pay. I'm sorry,
Federal Reserve.
The Fed isn't bailing him out. All of us are, the taxpayers. Let's be real about this. Okay, but he didn't really take even that much risk because every one of these things, with the exception of that credit card loan, was collateral, right? So, Mike, if Ben didn't pay you for that house, what are you going to do? You just going to foreclose on that? Get your money back? As long as you did your underwriting and Ben, did a good job and bought a house under value, which I'm sure he did. He's an expert at this. I mean, then you're pretty safe there. The car's a little tricky though, because cars do go down in value. But you got a good repo company. Does anyone own a repo company in here? Just saying, that's a really good business to get in right now. Because delinquencies on car loans is through the roof. But anyway, you could just go get the car. The home remodel loan, I mean, if they don't pay for the kitchen, you just go in and put a lien on their house. Eventually, when they sell their house or when they pass away, you just get paid then. But it's not your money anyway, so you don't give a shit. I mean, but really the only loan on here was the debt consolidation that he took any risk on, but he got paid to take that risk, right?
Got paid a nice return.
12%.
12%.
So Mike, you made 20% more than I did, and you used my money and all of our money to do this? Yeah, thanks. Holy crap, now I understand why we all want to be the bank. Because they made 20 net, because they made 20 after paying us the 4%. And when the Fed drops rates, do I still keep that 4%? Probably lower it. Yeah, you're definitely going to lower it. Who are you freaking lying to here? You're going to lower that rate as soon as you can, but you're not going to lower how much you lend it out at. All right, so you can all see, we're just trying to have some fun with this. The bank made 20 net. We made 4%. 4 into 20 is 5 times more. That's 500% more. You've all seen this. And, I know we're just trying to make fun of this, but like, how many of you want to be in the banking business now? I'm surprised only 2 of you said you have a bank. Mauricio wants to be in the banking business, but he is. And all of you are. You just don't need to have a physical branch. All you need to understand is how banking works. And was that difficult to understand? Not at all.
And here's the cool thing is the highest rate that he was offered, the bank was receiving at 12% for an uncollateralized loan. What is everybody learning in this room here these 2 days? How to earn a 12% return, be in your own bank, collateralized.
But there's something funny that I got to bring up. Before we got started, and I was picking on Mike over here for a reason. When Mike, you were 16 years old, I think you said? 17 years old, your mother gave you some really good advice that at a 17-year-old young buck, you thought was terrible advice. What did your mother tell you to do?
At 17, she said I had to buy a whole life insurance policy.
Wow.
At 17, she didn't say, hey, you should. Can you just say that again, how she said that?
She said, she was going to buy it and I had to pay for it. And
but she didn't really give you an option, did she, Mike? You see, back in those days, the good old days, as we like to call it, our parents had our best interest, but they didn't give us options. They're like, you're doing this, you little spoiled shit. Yeah, you're doing this. And he didn't like that. But how did that pan out for you?
When I bought it, I had to pay $136 a year, every year. And I was so upset. But then, it took several years before and I actually investigated the policy and I said, hey, I can borrow this money. It's got some value. And so it worked out that I used that money to buy my cars.
How crazy is that?
Trying to figure out.
But infinite banking concepts hadn't even come around, right? Nelson Nash came up with that in the late 90s, right? But he was using, that was an IUL, wasn't it?
I don't know what it was.
It was only a whole life because that's all they had back then. They didn't have all these fancy new policies. They had whole life. That was it. And you used it to buy all your cars.
Started in 1968, I think, is when the policy started. And I didn't realize till the late 70s or early 80s what I had.
How cool, huh? Put your hands together for Mike. Thank you, Mike. Yeah. See, here's the funny thing. I think we are on the verge of a major shift in a lot of things. That's why I did all those stupid slides about the markets. We're in the middle of a major shift. But the shift is also shifting in a way that I couldn't have predicted. And that shift could be seen when you turn on the news or open up any paper and you see Kyle Busch and Samantha Busch and their little story about what happened with their IUL, about an $8+ million, whoops. Yeah.
Whoops.
I did a whole video on this. We're not going to get into that today, but if the truth starts coming out, like I have never seen anything like that on whole life because can you lose money on a whole life insurance policy? No, it's guaranteed. No. I guess if you started one and then, canceled it in the first year, you'd lose money. But after 3-5 years, like, no way. Like, that's the shift. See, Mike, and probably some of you in here, your parents or your grandparents said, here's a policy. They started one because they knew that was good for him. Okay. And they knew that. Today, that is just starting to happen. All of you, I'm sure. And there's I know you have a policy, don't you? Well, you're going to. Okay. Mom's not going to give you an option. She's like, here, you're going to take out a policy. So someone on our team might get a hold of him later. No, just kidding. But that's the shift. Whole life is going to become popular again where it has not been because it's boring. But boring is good. But here's where it's really good because once you learn how to use it, and I'm going to skip past this because this is just where is my money? We all know this. I mean, simple versus compounding interest, tax advantaged. Anyone in here like paying taxes? No?
This is all stuff we're going to get into over the next 2 days.
Yeah. So no one likes paying taxes. Volatility. Anyone like volatility in the markets? Like your money's way high and then the next day it's way low. Then it's really high. That's fun, isn't it? Yeah. No, you like steady Eddie stuff. That's why you're in real estate. Passive or active. I mean, all of you like working longer, right? Taking less time, more time away from your kids, less time doing the things you love, more time doing the things you don't. We all love that, right? So we like passive income. So you see, we're all here for the same reasons, but the point of the matter is this. I can just give you the numbers here, folks. This is a guy named Kevin. You're just going to have to pretend because we can't see the numbers, which I don't know what happened here. I'm sorry, but it's okay. So Kevin met us at an event like this. He was a real estate investor. I did a presentation after he came up to me and he said, hey, Chris, I heard your presentation. I really like that. I'd love to make money twice on my dollars. And I've been saving up because I want to do a real estate deal. And I've got a little over $50,000 in a savings account. What if I took that 50 grand and I just changed it and I put it into one of these stupid whole life policies that you just talked about that sounded pretty cool, but whole life does not seem cool to me. And I said, yeah, you can do that. And he says, well, then after that, I've been saving about $500 a month. Can I do that as well? Absolutely. You can put any dollar amount you want into these policies, into your own banking system. So I'm going to switch right now and I'm going to stop calling it a whole life policy. And I'm going to call it your own bank. Is everybody clear with that? So no longer talking about the stupid whole life. We're going to call it your private bank. So Kevin now is deposited $50,000 in his private bank. Every month, he wants to put $500 into his private bank to save. And then he wanted to find a real estate deal. But Kevin met somebody. Who else in here needs money? Rashad, I'm going to pick on you over there. Rashad's kind of short, so you may not see him over there. But Rashad needs $50,000. So Rashad comes to the same event. Rashad and Kevin get together, and Kevin says, hey, I got 50 grand I can lend you. Rashad says, well, hey, you'd be okay with 12%? You okay with 12? Can you pay a little bit more? How much? 15. So Kevin says, 15 is pretty good, because Kevin knows that his bank, his private bank, when he takes money out of it, he has a cost of capital. That cost of capital is the interest that the insurance company is going to charge him. It's about we'll call it 5% for simple math. Right now, they're like 5.35. Okay. So he takes the money out and he gives it to Rashad, to which Rashad pays him 15%. Remember back earlier. So we take the money out of the policy. Kevin gives it to Rashad. Rashad pays him 15%. Kevin puts that 15% back in his private bank. Simple, right? How much money is Kevin still making interest on? Started with 50. Let's just use simple math because you can't see the numbers anyway. Starts with 50, takes 50 out, gives it to Rashad. How much is still in his private bank earning interest and dividends? 50,000. Does anyone not understand that? Stephen, you want to help me explain that real quick? Because that doesn't make sense. If I put 50 grand in, Harrison's family's bank, and I take 50 grand out of the bank, I don't think Harrison's going to keep paying me interest on that money.
Harrison, will you?
Maybe. See, he's got the bank and now he's evolving the bank. But normally a bank, all right, let's just pick on KeyBank because I hate that bank. If I put 50 grand in KeyBank and I take the 50 grand out and I give it to Rashad, is KeyBank paying me any? Yeah, right.
No.
Zero interest, right? So we got that. All right, zero. But in this, what happens is the insurance company advances you $50,000 from their general account. Most of the insurance companies we work with have tens or hundreds of billions of dollars in reserves in these surplus accounts. So they give 50 grand to Kevin from the surplus, and then they go in and make a little journal entry in the ledger, and they just take 50 grand away from Kevin's death benefit, which I can't even see it on there, but so it doesn't matter. Anyway, we borrowed our death benefit while we're living. And the insurance company charges us interest because why not? They're going to make money on that. 5%. When you put the 15% back to him, he puts it back in, which is reducing the loan, increasing his spread. Because if he's paying simple interest on 50 grand that he gave you, but then you're giving him 15%, technically he's making a 10% spread. But now every payment you give him when he puts it back in reduces the loan. Is the insurance company actually charging him 5% on 50 grand? Well, no, they are, but every month it's less. 50, then minus the interest that Rashad pays and going down. So his spread just keeps getting bigger and bigger. This is just mathematics, folks. Boring. But see, the thing you can't see on here is by the second year in Kevin's policy, I'll try to see it. Kevin puts in $5,895.
Yeah, $491 a month. So
$491, because the insurance company wouldn't let him put the full 500 in. There are rules, MEC rules, IRS rules. So we don't need to get into that, but he was only allowed to put the 491 in. So he put 5895 in year 2, and he had his policy in the second year increased 7,141, which means he made $1,200. I know you can't see that, but $1,246. So if you did the math, if you took $1,246, and just so you all know, this is net. This is net of cost of insurance, net of policy service fees, and net of those massive commissions these insurance companies pay us. So 1,246 divided into the amount he put in, 5895, gives him a return of 21.14%. His cash on cash return on that year's deposit was 21%. His cost for the money was 5 or 5.35, if you will, right? I know this is a lot of numbers, but do you understand? Like, it doesn't matter if you even understand the numbers. Does that sound good? Okay, so we can move past this. That's all I was trying to show you. And this is what it looks like. It's simple. We start here. Okay, we got the policy we put. I'm just going to use an example of 100,000 because our numbers work here. We got 100,000 that goes in the policy. Where was that 100,000 initially? At KeyBank. But KeyBank wasn't paying us money like Felix wasn't paying us. We took it from KeyBank, Felix, and we put it into the policy. Now that was a dump in. Then every year we want to put every month we want to put $1,000 a month into the policy. That's what's happening here. Then immediately someone needs some money. Okay, so we have access to 93,308 in this example of the money that we put in. Notice how it's not 100%. This is literally a major issue. Stephen and I hear this, and all the mentors hear this all the time. This is why people don't do this. They're like, oh, I put 112,000 in the policy and I only can use 93,308. Yeah, that's it. Well, why? Well, because I had to get paid. Because I don't work for free like you don't. The insurance company had to get paid because they're not a nonprofit. Last time I checked, they make plenty of money, and we want them to, because if they make money and they're mutually owned, guess who else makes money? We do. That's where the dividend comes from. We benefit from the insurance company's profitability, because in a mutually owned company, you technically are the owner. There's no stockholders. Very different than the IUL companies. But again, sorry, I just got to keep putting that in there. But this is where people stop. This is why they don't do it. Can I ask everyone in this room a question? How many of you go to your local bank, deposit money, then go back to your same local bank, I don't care, a month, 2 months, 3 months, and take 100% of the money out of the bank? Anyone? I'm the only one that does that. Okay, right. But that's the thing. It's in your mind. Because so many people are like, I don't have access to all my money. You don't use all your money anyway, you dumbass. Like, that's what I want to say. That's why I'm not allowed to talk to clients anymore. Because I tell them the truth, and
True story.
They can't handle the truth.
True story.
All right, so let's keep going with this, because I know I'm going long here. So we take 93,308. Now that 93,000, what we teach is that goes into what's called a segregated bank account. You know what that is? Nothing fancy. It is a separate bank account. We are working on some things right now where we're going to basically be able to give you a segregated bank account, but yet you're going to earn interest on it. Does anyone earn interest on your checking account? 2, 3 people, 4. Okay. How many of you, I think everybody in here would like to earn interest on your checking account, right? So we're going to make that happen for you. It's coming soon, but 93,000 goes into that segregated bank account. Then what we would do is we find somebody in this room. Does anyone in this room need $93,000? See how simple that was?
A few.
There we go. All right. I'm just going to pick on Jamie just because she's right here. Jamie needs 93,000. So we're going to lend it to Jamie. She's going to pay us 12%. We're going to take those gains, which is 11,165, put them back into the segregated account. Why? Because that's what you do anyway. That's what every one of you would do. You'd put it back in the bank. But then what we're going to do is we're going to add one step. And we're only going to do this one time per year. Okay? We're going to make a payment to the insurance company for the interest on that money that we borrowed. 4,652 is what we're showing. The 6,513 stayed in that segregated account, and then we're just going to redeploy that. Now, this is not what I do. I want to be clear. I'm just showing this for simplicity. What I do is I take 100% of the 11,165 and I move it back into my bank, because I don't like leaving money in somebody else's bank. But it can be done both ways. So what I'm trying to explain is there's no one right way to do this. There's just your way. My way, I put it all back in. In this example, I'm just showing all you're doing is paying the interest back to the insurance company, which leaves 6,513 in the policy, in the segregated account, while you still earned interest and dividends on the full 93,308. Now, if this was a policy design like Kevin's was, how much would you have made the second year on cash return? Roughly about 21% in that example. Now, is that your actual total return, your cumulative return? No. That's just the return on new deposits going in, but that's only what you should be counting. Because if you already put the money out to work, that's fine. Because if you already sent the money out to work, then that money's working for you. So we're not going to count that. So many people screw this up too. They want to know, oh, Chris, you're wrong. I get this all the time. Haters come out like crazy on this one. They're like doing the math and like, nope. You put 112,000 in. You're not earning 21%. I know. I'm not earning 21% on that, because I'm earning 21% on only the new dollars. Because the goal when you're a bank, Mike, if you owned a bank, your goal would not be to keep a bunch of money in the safe. Your bank would go out of business. You got to move that money. Folks, all of you, if you become your own bank, you must get good at moving money. Putting money in a whole life policy will never make you wealthy at all. It's just a wee little bit better than the other options. So in order to become wealthy, your money has to work for you. In order for you to get freedom of time, your money has to work for you. So the goal is not to load up a policy and leave it sit there. The goal is to put money in the policy, get that money out to work, which is why you're all here. Because there's only 2 types of people with money and people that need money. Everything making sense so far? All right. Everybody in here knows what a home equity line of credit is, right? Who in here has equity in their homes? Everybody. Remember the chart? Home values that are at record highs. You got equity in your house. Is that equity in your house changing your life? Do you go home every day, stare at the wall, and say, thank you for having equity? No, it's not. You're not even taking your kids to dinner. with that. But if you took that equity and you extracted it from the walls and you put it into a deal here, somebody that needed to borrow money, now is that money working for you? Yeah, I don't remember what it was, $11,000 or whatever. Let's say it's $300 a month that you're making on money. Like, is that enough to take your kids out to the movies? Is that enough to take your kids out to another dinner, your family out to a dinner? Aren't those the things that we remember? You see, I've talked to a lot of people, you know, I have a gentleman that works for me, he's 80, and we talk about things that I don't like talking about. We talk about, like, in those final moments, what are the things that you're going to wish you had done more of? What are the things you're going to be thinking about? Is it, oh boy, I wish I had another Porsche in the garage. Oh, I can't wait to have my kids have the Porsche that I spent my whole life working to save for. Or I can't wait to pass my house to them. No, you know what you're thinking about? Those moments. The time you spent with your loved ones. That's really what legacy is all about. So keeping money in your walls of your house is doing nothing. Please get it out, get it to work for you, and get it making money while you go and enjoy your life. And that is what this shows. So if you did an all-in-one, all we're going to do real quickly, okay, we're going to take the money from the home equity line of credit, the money that was in your wall. We're going to put that into a policy. Now, this is just one example. You could just lend direct from that, but you're going to take that and you're going to put it into the policy. Then we're going to find a way to lend that money out. Now, there's a couple things here. Here I show an LLC, because is it smart to lend from an entity? Yes. That's all you need to know. You can lend personally, but it's smarter to lend from an entity. Can anyone tell me one reason why you should be lending from an entity? Protection, but that's not. How about just tax write-offs? Let's just call it what it is, right? The entity allows you a lot more privileges, and I'm not a CPA, so consult with your tax professional, but allows you a lot more opportunities to get tax write-offs. That's it. Is there any more reason you need than that? No. This trip you're on right now, you could have paid for this from the entity that you set up to lend money from, and guess what it is? It's a write-off. So go out and buy the most expensive bottle of wine tonight. You'll thank me later. Maybe not. We do have Motrin. I think all of you got Motrin in your bag, so that's why. All right, so you put it into the entity, you lend it out on to somebody, you make 12%. Rashad's already saying he's paying 15, goes back into the entity. Then from the entity, it goes into the entity's bank account, which is this segregated account. And then we just take it and we just put it back in the HELOC, and round we go. See how that works? We kind of did it like this little snake thing because we wanted it to mimic infinite banking. Oh, of course there's interest on the HELOC. Yep. Into the policy. Then you're paying interest to the policy. And then you're lending it out. Yep. But here's what I didn't show here. And I didn't want to rain on their parade. You're going to hear more about this, how an all-in-one works. And the reason this works, I would never tell you to do this if it was just a normal HELOC, because there's a lot more moving parts. But here what's happening is every dollar that you earn, your W-2, your 1099s, the interest everybody's paying you, is going into a bank account. That bank account is attached to that HELOC, that all-in-one HELOC. So every dollar you make that goes into your bank account is paying that HELOC down. That make sense? The all-in-one is one combined thing. You'll hear about that in a second. So that's why we show it this way. I'm just trying to give you the ideas, but I love where you're going, because like you're thinking, well, Chris, that makes absolutely no freaking sense. Why would I pay interest to this bank on the HELOC, then pay interest to the insurance company, then lend it out, go through all this work, and then I pretty much lost everything in interest? Hold that thought. They're going to explain that, I hope, right? Okay. All right. I'm not going to go into this stuff. Because we're running out of time in this right here.
Yeah, all you really need to know is we'll mathematically show you this too. So whatever your situation is, we can plug it into the BYOB vault and show you exactly what all that looks like, the good, better, and best way to do this stuff, whether it's paying off debt, investing, all of that. It's that's all BYOB vault stuff right there.